guys, welcome back to the Capital Mindset Show. I apologize ahead of time for my hat here. It looks kind of ridiculous in my opinion, but we'll see. All right. So what we're going to be talking about today is another subscriber request. It's going to be BERY International. Okay. So ticker symbol BERY. And I actually got requested a lot for this one. I think it has something to do with Sven Carlin's video on it, which I'll go over, I guess, some of his points because I guess they're pertinent. And the reason why I think that is when I looked up BERY just to see if there was any sentiment out there. One of the main things actually recommended by Google was Mr. Sven Carlin's video. So I think that has something to do with that. But anyways, we're going to get into it. So BERY International, for those of you who may not know, to catch everyone up to speed, it's quite simple. They produce packaging, right? What kind of packaging? Well, you know, you go to the store and you pick up a Lysol, that packaging, right? That plastic container that the Lysol is inside of. Well, that's what BERY makes. And actually, I think I'm fairly certain that they actually do service Lysol, which I believe is owned by Procter & Gamble. So the end customer, immediately what comes to mind is who is the customer, right? Is it you or is it Procter & Gamble, Clorox? The answer is quite simple. It is Procter & Gamble. It's Clorox. It's not really us. We are the customers of the retailer that sells Procter & Gamble products, right? So that's our experience. And then Procter & Gamble cares about their packaging solutions because they want an efficient form, a high quality, but for the right cost. And these are all things that they're going to be balancing in. And that's actually really important later down the line when we talk about certain things. All right. So I think the first thing we should talk about is the price action more recently. And so BERY International was actually talked about by Sven at around the 70s. And his conclusion was it's an interesting business, but there was some issues regarding we'll get to that. Taking a look at what it's done more recently, it's about, it's come down a little bit from the 70s to, about 17% down. It's outperformed the S&P 500 since IPO. However, more recently, if you take back the past 5 years, it's actually underperformed the index quite significantly. What I mean by index is the SPY. Okay. So 18% is nothing it's not that good. So when I saw what Sven or Dr. Sven says, because he has a PhD, he says that it's a cyclical business. And I think what he really means by that is more or less the performance of the stock price has been quite cyclical, and it has something to do in relation with the actual dynamics of the macro environment. And when we look at the earnings, I want to actually kind of be a little bit more clear about that. It's not traditionally cyclical. It's not going to appear so. And then we're going to talk about that. But for the most part, I haven't really even seen any of the stuff because I actually like to do these videos raw and kind of give you my thoughts and then not give myself time to really think, just kind of off the cuff comments. All right. So I have a lot of these documents already pulled up, and we'll actually go visit, for example, the presentation first. So in the presentation, again, this is the sales pitch. I'll try to go as quickly as possible and highlight the most important parts. So right here, we're going to see literally BERY at a glance. And we want to see here, or what I would like to highlight to you guys, is the exposure internationally, right? 30% of revenue is a good amount. 23% in North America. And this is just for the consumer packaging. So this is, again, yep, I think my eye saw it. Yep, there's a Lysol right down there. So yes, they probably do Lysol. And then they have health, hygiene, specialties, 23% of revenue, and then engineered materials. Okay. So we want to actually later down the line, let's see if they tell us which one is their growing segment, because that's going to be quite important, or something interesting to note. Okay. And then you can see they are an international company. We can see they have 300 plus locations in 39 countries, all that jazz. Okay. So let's take a look at okay, so that's fluff. So I'm going to be skipping over the fluff stuff that's like patting themselves on the back. That's what I usually like to call that stuff, pat yourself on the back presentation stuff. So right here is actually where it begins. I actually want to talk about some of this. So right here, immediately when I see this revenue growing and EBITDA, operating EBITDA, not growing as much, I do poo-poo on EBITDA a bit. Okay. I know that, but everything is nuanced, and there are some things we can learn from almost every metric. So for example, EBITDA is basically earnings just before interest, taxes, depreciation, amortization. What can that tell us? Well, that does include all the costs relative to the product, right? In EBITDA. So if revenue is growing by 30%, but EBITDA is only growing by 4%, immediately my mind is saying, margins are being squeezed, right? So that's right there, boom. Adjusted EPS, okay, that's growing by 33%, but there's a whole host of things that could cause that, right? Maybe depreciation is not as much as before, right? So there's a couple, not tricks, because I don't want to use that word, but there's some things that could cause EPS, GAAP EPS, to actually be higher. Looking at revenue and EBITDA, that's telling me that's a little bit more important of a comparison, because that's telling me margins are being squeezed. Probably the gross profit margins being squeezed. And then understanding that we're in an inflationary economic backdrop with regards to production, that's a little bit concerning. So my mind's going there already. Let's go to the next one. So right here, we're seeing, I guess, the segments, and we see organic growth and then actual growth. Again, we're seeing the same story here. So revenue is about 40%. And by the way, this is international and North America, but revenue is growing 40% North America, but negative 1% in operating EBITDA. So with right there, that's telling me margins are being squeezed again. And then organic sales is 6%, but actual growth of 40%. That's telling me acquisitions. They probably did acquisitions. So we're probably going to be seeing some goodwill on the balance sheet. And we'll actually talk about that later. So the model is probably going to, it's not probably, it is going to highlight that for us, and I'll be able to show you guys some things. 3% organic growth over here on international, 15%. Okay, so more acquisitions and not as much EBITDA growth as the revenue. So again, margins are being squeezed, just not as bad as North America. Okay, taking a look at here, same story. So I think it's the same story across the board. And I think health and hygiene is their fastest growing segment, 11%. Just to check, 3, 6, 11 and -2. Yes, it is. Okay, so, but similar story. Margins are not, it's not growing as much as the revenues. Therefore, something's giving up. Okay, and it's probably margins. All right, so taking a look at here. Okay, so this is actually the cash flow. So they are expecting cash flows to be about $1 billion. And EPS to be 7.2, 7.7. This is with operating cash flows of about 1.7, 1.8 billion, with capital expenditures of 800 million. All right, pretty good. Other assumptions, this is organic growth, okay, of 2%. And that's what they're assuming, I guess, there. All right, so let's take a look. Oh, I saw interest expense. Yep, interest expense of about 280 million. All right, and then depreciation. I don't care about that really. Okay, so this. Okay, so they're doing share buybacks. Okay, for those of you who are dividend investors, they're thinking about it. Portfolio management. Not too excited about that stuff, but sure, whatever. All right, so CAGR. So this is showing the growth rates over the time period measured 2015 to 2021. Good revenue, good on operating EBITDA. So over the longer term, they actually kind of matched it in growth. Adjusted EPS, I don't care. Adjusted free cash flow. Okay, so it didn't grow as much, but it's fine. Nothing too crazy. And okay, here they're highlighting they did outperform the S&P since IPO. Okay, international stuff. Oh, okay, so that's patting on the back. Patting on the back. I think we're done here. Yeah, we're done here. Okay, so I think I'm going to segue over to this document over here. And this one actually is quite important because it's showing the, this is the annual report. And I went to the balance sheet. And right here, we have the current assets, inventories, and all that jazz. Cash and cash equivalents is growing actually 750 to 109, sorry, 1,009. So that's $1 billion. And doing right there, oh, right there's goodwill and other intangible assets. So that's, I hope that's not that. That's not all goodwill. So goodwill is an accounting line item that often is the center point of fraud. I'm not saying this company is doing that, by the way, not at all. I'm just actually giving you guys the backdrop of that. So goodwill, in simplest terms as possible, to kind of move on from here, is when a company acquires another company, another asset or something, and has an estimated value, right? It's kind of questionable how to estimate that value, but let's say we estimate a value, and that value, right, is, let's say it's $1,000, but I buy it for $2,000. So that extra $1,000 that I overpaid for the business will go into an asset line item called goodwill. Now, in the future, if something happens to that asset where it's not actually valued at $2,000, so remember we have that 1,000 goodwill, we will impair that asset and bring it down. So a lot of people sometimes make the wrong assumption that a goodwill impairment, because it reduces EPS, is something that can be tax deductible. It's actually not at all. Okay, so just because it's an expense doesn't mean it's a tax deduction or anything like that. Tax accounting and GAAP accounting are different, just so everyone understands that. Not to get into an accounting video, but then on top of that, that kind of write down is actually a below the line item write down. Okay, it's not actually affecting taxes, but it is represented as a loss or a reduction to net income. But again, goodwill impairment is what we call that. I'm not saying that that's going to happen here, but just so you understand goodwill, it's an asset. It's not really something that we should truly value it as an asset. I like to take it out when I try to be conservative. If you look at the tangible book value, which we will look at, we do remove those. But anyway, and then intangible assets, that can include the brand and stuff like that, things that we can't really touch or feel. That's what intangible means. Again, and we don't know if the inventories are exactly going to be sold at the price. So for example, in an event of liquidation, what is the value of that inventory? Well, they have a value ascribed to it, but does that value actually represent the real value? Maybe, maybe not. All right. So taking over here, look at that long-term debt. Now it is being reduced, but that is a lot, right? If we go back to this market cap, which I didn't even highlight, it's 8 billion over here. So going back to this document, 9 billion in long-term debt, that's more than the market cap. So already there, that's actually what something Sven correctly pointed out. It's the debt. The debt's probably the biggest problem with this business. Now, it doesn't mean it's a bad business, it just means they have a debt problem. They are planning on getting rid of it or hopefully bringing that down. Okay. So I think it's time that we actually head over here to the model, right? And we got to type in BERY. I didn't have time to change the color, guys, from the last video. So bear with me. If you guys didn't like it, I apologize. So I'm going to go over here because I know some of you like to actually see this. So right here, you guys can pause here and just take a look at that. Nothing stands out really as something crazy. So yeah, that's about it. All right, before we even look at this, we're going to go look at the key ratios, but I want to highlight some things right here. So right here, the model's picking up on two instances, the Altman Z-score and its own metric, that the business is unknown in terms of its balance sheet risks. So it's not a good thing. It's not necessarily a bad thing. It's kind of in the unknown criteria. So 1.7 and a not available. Okay. So I want to highlight some other things over here. Return on assets. I'm not going to be too picky on that one for this type of business. Return on equity is pretty solid here. However, I want to actually say that this equity value has probably a lot to do with book value, or not book value, sorry, goodwill, right? Because immediately when my eyes go down here, I see a book value of 24.53 and a tangible book value of 32.08. Well, remember, let's go back to here. A lot of these assets, right? Look how much of these assets are intangibles. Well, we can take out about 7 billion and we're left with 10 billion in assets. And then the total liabilities supersede the total assets, right? Because they have so many intangibles here. And I believe, I'll just tell you guys the number. I think it's like a 5 billion or 5 point something billion dollars in goodwill, and the remaining 2 point something is in intangibles. So it's quite a bit of goodwill. They did do some acquisitions. And again, if we go back to, well, somewhere up here, they had organic and inorganic growth. So that was the hint that they're doing a lot of acquisitions. Okay. So that's why they have a lot of goodwill. And the tangible book value is actually a negative 32.08. Is that a deal breaker? No, it's not, but it's something to note. Right here, the model's picking up that they're at a debt heavy financed business. And because of that, we actually want to make sure, and they're also diluting us by about negative 1.01%, not too much. So they mainly use debt, but they are using some shares. They did say here in this presentation that their focus in the future is potentially doing share buybacks. And they actually announced the buyback program, which is actually quite large. And again, they will do dividends in the future. So we do know that might actually come down. Dilution accretion is actually something you want to measure now. And actually what it shows is the dilution that they've done has actually resulted in a positive accretion. Remember, we only look at this if this is negative. If this is positive, we don't care about this. Yes. And again, some of these things are not functioning properly as of yet. Remember, give me a couple weeks. All right. On that note, let's go to the key ratios, and let's not start with these. That's spoiler alert. So liquidity ratios, pretty okay. They have enough for the current assets, current liabilities. Going to the solvency ratios, we do see some improvements over time, but still not where I'd like it to be. And then going down to the DuPont analysis, remember those margins I was talking about? Well, yeah, we're seeing the gross margins kind of come down about 100 basis points, over 100 basis points, almost 200 basis points. Operating margins coming down quite quite nicely in a bad way, by the way. I said that as if it was good. And net profit margin also kind of coming down a little bit. ROA, ROE, ROE is good, but I'm questioning really that metric too much. Okay, but ROA, it's not the best, but maybe more so in line with what kind of business this is. It's not. I don't really go against them too much there. So taking a look over here. Oh, this should have been already porting in, but I guess I'll go ahead and fix that. Earnings quality has been solid all across the board, and then and then I won't go into activities ratios just yet. Let's go to the valuation, and let's actually start with our discount rate. I think for something like this, we should demand a little bit more of a discount rate rather than the market average. And I think they might, for now, I'll just say 0%. I don't want to assume any buybacks right now or share dilution. But let's actually assume some growth rates. So they have grown about 6.65%. And I think they gave us a longer term growth rate. And I think it was organic volume growth. So 2%. Oh, that's volumes. It's not really actually revenue. So, but let's actually assume that that's going to be the negative amount, right? So that's on the down low. And then on the high end, they're going to continue to do 15% per year. And then somewhere in the middle, they're going to do about 6 or 7%, right? And then somewhere in there, we'll do 10. And then right here, we'll do like 5. So right off the bat, this is the model's telling me that the allocation percentage could be 5.91%. And that's based off of the risks that it sees, what I'm telling it will happen, and all the like. Now, I want to use a custom weighting, let's say, because I think it's more likely that we have a concentration in the lower end of the growth. Now that brings down the allocation percentage to about 3.46%. So now it actually becomes a smaller allocation because I'm basically telling it that I believe the result will happen more likely in this 3 scenarios. So let's see what happens if I demand a greater return from the model. Well, now it's saying it's not worth it based off of these criteria, right? Is it right? Is it infallible? No. But it's a good, smell test. Say, okay, what's going on? Now, I think they're going to be pursuing some forms of buybacks. And I think that's going to reduce, again, the share count over time. With these assumptions, you see how it actually gives us some more flexibility. But we do have to assume more growth than what they were penciling out there, I guess, on a conservative measure. I do want to say that the estimations are a little bit drastic, I think, from the analysts. And by the way, the analyst, it's not porting in for this company. It does normally point for other companies, the price targets based on analyst recommendations. Analysts do say it is a strong buy, but there's no price target porting in for this particular company. For most companies, it will do that. So taking a look over here, this I think is quite high for the estimations, but the revenue estimation I think are quite in line. There might be something that I'm missing in terms of understanding why they have such high estimations, but I'm not really seeing it. I think it's going to be more or less in line, about $1 billion. Okay, so that would be like saying perhaps it's going to grow around 15% compounded for the next 10 years. If you think that's going to be sustained, I don't think it's really priced for that. I think if that does happen, it's very undervalued right now. And if they do, again, dividends and buybacks, they return more capital to shareholders, that's fair enough. Whether or not I want them to return more capital to shareholders, looking down at this number over here, I actually do want them to. So I would prefer them to actually, give me the money. Give me the money. Don't keep it in the business. Keep only what you need to invest in some growth aspects, pay down the debt, keep the business healthy. But other than that, after that, give me the money, because you're not really making a good investment on that money versus what I believe I could do. Okay. So again, I'll go back to the 15 to show you guys that. And then the 20 show you guys that. Okay. My final thoughts on this business is it's a very interesting business. I actually want to highlight that. I think that there's a lot to be excited about. There also are some concerns I have, and the concerns are mainly along that balance sheet. I want to see them reduce that debt. Of course, I think if they do reduce that debt, perhaps the stock price performance will improve, because that actually will materially reduce the risk on a name like this. And you are still, looking at a fairly solid business, a company that, everyone kind of needs, right? But actually, this is the final point, because I think it's actually really important. And I think this is one of the biggest risks that you have to consider. This is a more of a macro outlook on this industry. And that is, well, if we're seeing a lot of producer price inflation and there's consumer price inflation, but not to the same degree as the producer price inflation, well, that means that the margins of Procter & Gamble, Kimberly-Clark, all these consumer companies, they're getting squeezed, right? And so you got to understand that who's this guy's customer? Well, this guy's customer is, let's say for argument's sake, Procter & Gamble. Well, Procter & Gamble wants to keep their margins. Well, then they're going to pressure this company. And this company doesn't control the end consumer, right? The branding is all with Procter & Gamble. So they have the power. And we've discussed this in videos like Foot Locker, for example. You want to actually think about who has the power in the relationship. Well, Procter & Gamble definitely does have the power. And so these guys have to always compete, right? And then if we go back to these margins, right? These margins aren't crazy margins. And that's the wrong one, this one. All right. So these margins aren't crazy margins. They're not bad margins. They're not bad, but they're not crazy. And I bet you that the lower margins are happening because things are getting a little bit more competitive. Okay. So it is a competitive industry. And I think that's more or less what Sven was saying when he meant by it's cyclical. It's very low moat, very low barrier to entry. So the actual moat itself is the efficiency of the business. How efficient are you at producing these products and then getting them to your customer, where your customer wants you, and then you have a reputation with them and all that. So that's a concern. Increasing competition, that's a concern. If the producers are not able to pass on the cost to consumers, then that's a concern again, because then competition becomes a little bit stronger, because then, Procter & Gamble is going to get a little bit more angsty to replace you, or your margins are going to get squeezed. One or the other thing is going to occur. And then you're going to get that situation where revenue is rising faster than the EBITDA margins or whatever the heck, the margins are going to be squeezed for you. All right. So those are some concerns that I have. Will they manifest? I don't know. I don't think so. Am I adding this to the portfolio? No, not yet, but it is going on the watch list. I am interested in this business. I think it is a good business. Okay. I'm interested. I kind of like it. It's boring. It appeals to me in that sense. I have a soft spot for boring companies. All right. So on that note, guys, I hope you guys enjoyed this video. And if you did, go ahead and leave a like. If you guys want more videos like this, go ahead and subscribe, and then your stock that you like might come up. You never know. I'm building slowly a library on this channel for all these different stocks. And you guys have any questions, go ahead and comment down below, and I'll do my best to respond in a reasonable time frame, again, with everything going on. If you, again, like if there are some things I missed, please comment down below. Feel free to share with the community, kind of provide information or insights as to what you think about this company. Say, okay, these are some things that you missed in terms of the risks. Maybe I wasn't talking too much into some risk. Maybe I was being, too risk averse, or maybe there's some things on the bullish case that I missed out on and need a little bit more detail. Okay. So on that note, guys, I hope you guys have a great one. I'll see you guys in the next one.